Today, property signs for the 10th of August 2021. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. In today's show, we look at the latest mortgage rate hikes, higher unemployment data, issues with loan processing during COVID, and NAB's acquisition of Citi in Australia. Australian employment dropped by 176,000 in July as all 5 mainland states experienced lockdowns, according to the latest data from Roy Morgan. And they showed that 1.42 million Australians were unemployed in July, up 28,000 in June, for an unemployment rate of 9.7%. The latest Roy Morgan employment estimates for July shows unemployment up 0.3% to 9.7% and underemployment up 0.6 points to 9.1%. This means a total of 2.76 million Australians, or 18.8% of the workforce, were either unemployed or underemployed in July. That's the highest monthly figure since February 2021, when it was at 3.07 million, or 21% of the workforce. The increases in both unemployment and underemployment in July are not surprising if you consider the number of lockdowns around Australia over the last few months. There have been 3 lockdowns in Victoria, 2 lockdowns in Queensland, a lockdown in South Australia, a lockdown of Greater Perth, a lockdown of Darwin, and an extended lockdown in Greater Sydney, which began in late June and is set to continue at least till the end of August, and probably a lot later than that. The multiple lockdowns are especially detrimental to travel and tourism industries, and for those in the retail and hospitality sectors. Already Qantas has stood down 2,500 staff as hundreds of flights are cancelled due to the lockdowns and state border closures. And the damage to the retail and hospitality sectors continues, with trade disrupted and stores forced to close again. The renewed lockdowns in southeast Queensland and Victoria, as well as the extended Greater Sydney lockdown, will cause more economic damage and higher unemployment and underemployment in August, with more than half of the population now in lockdown, they said. The contagiousness of the Delta variant means these lockdowns could continue throughout August and into September and beyond. Nevertheless, the increasing support provided by federal and state governments to businesses and employees forced to deal with lockdowns and border closures is, they say, having an impact. The July 2021 unemployment estimate of 9.7% is well down from July 2020 at 12.5%. And during the remainder of 2020, unemployment only dropped below 12% once, and that was after Victoria's long second lockdown ended. Of course, they say, the key to ending the lockdowns is a high enough vaccination coverage of the population to prevent the spread of COVID-19 getting out of control. And the latest projections show Australia is not likely to reach the target of at least 70% of adults fully vaccinated until around the end of the year. To which I would add that it is not clear to me yet whether in fact vaccinations will really solve the problem. There is significant information suggesting that in fact the variants will continue to vary, and therefore there are some questions about the efficacy of the vaccination program. I think hanging everything on the vaccinations is a bit of a one gamble, which to me looks a little worrying. Now, elsewhere today, Commonwealth Bank has raised its flagship 2- and 4-year owner-occupied principal and interest rates on their mortgages. It's now teetering on the edge of the symbolic 2% barrier for 2-year interest rates, with the new price set at 1.99%. And while that's just a 0.05% rise across both rates, the 4-year rate now stands at 2.29%, and it confirms CBA's thinking that the era of ultra-low interest rates is well and truly over. Where CBA goes, the majority of other lenders will eventually follow, as evidenced by their latest rate rise, which has been followed by almost 30 other lenders hiking their price too. Now, the RBA, of course, insists that the cash rate will not rise until 2024, but CBA has predicted this will happen much earlier. CommBank's lowest fixed rate is its 2-year owner-occupied fixed package rate of 1.99%, which has a comparison rate of 3.94%. And that's since 0.2% higher than the lowest rate in the market for the same term of 1.79%. The trend of increasing fixed rate continues, with CanStar's research showing 36% of lenders have increased at least one fixed rate in the past 2 months. Commenting on the rate moves by CommBank, CanStar's Group Executive Financial Services said CommBank's rate increase today is further evidence that the interest rate cycle has bottomed. When the cycle turns up, it's fixed rates that move first, exactly the interest rate action we've seen over the last couple of months. The majority of interest rate increases have been in 4- and 5-year fixed rates, but with Australia's biggest home lender increasing its 2-year rate, we might not have to wait as long as the Reserve Bank is saying to see a flurry of rate rises. CommBank's upward moves looks like fine-tuning, but they put borrowers on notice that rates can and will go up. Fixed rates should be at least on the borrower's radar, with 2- and 3-year fixed rates still the lowest in the market, they said. The decision for borrowers to lock in with a fixed rate right now has the added pressure of choosing the right length of time to fix the rate. The challenge facing borrowers is not just the decision between variable rates or fixed rates, but also the fixed term, explained Steve Mickenbecker. 5 years can lock in repayments at a reasonably low rate for a couple of years beyond the Reserve Bank's expected start for the cash rate increases. Alternatively, 2 years can lock in a much lower rate and give a second chance to fix before the Reserve Bank is expected to move the cash rate up. Borrowers might consider a cocktail of loans, leaving part at a flexible variable rate to take extra repayments, which are usually restricted for fixed rate loans. They don't want to miss out on the great opportunity that today's low rate presents to get ahead. Other lenders will be considering following CommBank's increases, and with processing time stretched at some lenders, borrowers might want to ask their lender about rate lock to protect them from any imminent increase. And as the Delta variant continues to spread across the country, recent lockdowns in Victoria and Greater Sydney have sent most people back home for work and schooling. According to brokers, this has resulted in already blown-out lender turnaround times becoming even worse with some lenders. Speaking to MPA, mortgage choice broker Chris Howitt said lender SLAs had been a mixed bag throughout the Victorian lockdown. We've been able to get some good service and some bad service, he said. While some assessors have been easier to get through to, the systems of some banks have failed to meet the changing needs that snap lockdowns have created. Because the assessors are working from home, the bank systems are not up to it a lot of the time, he said. Turnaround times are disgraceful with most banks, but they are a bit worse because the assessors aren't getting the documents on the system properly. We're having to resend documents a lot more. That's a slower process. On the other side of the coin, the work-from-home environment has brought unexpected benefits for some. A lot of assessors are ringing us on their mobiles, and we've actually been able to call them back and have a talk to them, said Hallett. Moneyquest Cheltenham and Bureau broker Marcus Lowe pointed to many assessors being more forensic in their approach during lockdowns. This may have less to do with lockdown and COVID and more to do with the influx of new assessors being employed to cope with the demand, he told MPA. I can't speak on behalf of lenders. I can only make the assumption that these new assessors don't have the same level of experience, so are requesting information that might not necessarily be needed to support an application. They are perhaps trying to tick every box out of fear of recourse, rather than look at an application on its merits, which is causing blown-out turnaround times. Some lenders have tightened their policies and loan assessment criteria in response to the extended lockdown in Greater Sydney. The Commonwealth Bank recently said it would announce temporary changes to policies as a result of the current coronavirus situation that involved heightened scrutiny of any loss or reduction in mortgage applicants' income. while Resimac has requested brokers ask New South Wales loan applicants whether they've been affected by the lockdown and whether it has impacted their income. Resimac has also asked brokers to ensure borrowers provide evidence of that impact, such as a pay slip for their most recent pay period. Despite many financial services companies transitioning to digital technology in response to COVID, this process hasn't been implemented across the board, causing challenges for both brokers and clients. Howitt said while many lenders have bought in DocuSign, many others haven't. It's surprising how many people don't have printers at home, he said. I've never had so many clients have to go to Officeworks to go get stuff printed and scan it back in. And the major bank NAB has entered into an agreement to buy Citigroup's Australian consumer businesses for about $1.2 billion. NAB has confirmed that it has entered into an agreement with Citigroup to purchase its Australian consumer business. The deal includes Citi's $7.9 billion home loan portfolio covering around 1.4 million customers, a $4.3 billion unsecured lending business operating under the Citigroup brand, as well as white label partner brands, and $9 billion in retail deposit businesses and its private wealth management business. The deal, if finally approved, will reduce NAB's CET1 ratio by 32 basis points, and the proposed acquisition, NAB thinks that pre-tax cost synergies of around $130 million per annum are expected to be realised over 3 years, with the majority achieved in the first 2 years. Those synergies are expected to more than offset the impact of revenue decline in the mortgage book, which NAB assumes it will not be able to fully retain over time. Additional synergy benefits include potential revenue upside from expanding white label relationships and distribution of NAB products to Citigroup consumer business customers. Around $220 million of capital is expected to be released approximately 3 years post-completion, following the migration of the Citigroup consumer businesses to NAB and the achievement of advanced accreditation status. Citi's client base is largely mass affluent, and the mortgage book is largely owner-occupied, around 73%, while NAB's owner-occupied book is 62%, with just 17% being fixed rate compared to NAB's 27%. NAB has also agreed to acquire the shares in Diners Club Proprietary Limited, subject to certain additional conditions. Citigroup's institutional business in Australia is not included in the deal, and as part of the proposed acquisition, senior management and approximately 800 Citigroup employees are expected to join NAB. Completion of the proposed acquisition is still subject to regulatory approvals, including APRA, the ACCC and Treasury, but is currently expected to occur by March 2022. NAB has said it will pay Citigroup cash for the net assets of the Citigroup consumer business, plus a premium of $250 million, with the required equity for the deal totaling around $1.2 billion. That's equivalent to an 8 times multiple of the Citi consumer business. It'll be fully funded by NAB's existing balance sheet resources. While both NAB and Citi have recently unveiled alternatives to credit cards, with NAB's no-interest straight-up card and Citi's new Spot Buy Now, Pay Later offering set to launch later this year, the major bank said that credit cards remained an important product. Indeed, it suggested that the primary attraction in acquiring Citi was the opportunity in unsecured lending. NAB Chief Executive Ross McEwen said the proposed acquisition supported NAB's strategic growth ambition for its personal banking business. The proposed acquisition of the Citigroup consumer business brings scale and deep expertise in unsecured lending, particularly credit cards, which continue to be an important way for customers to make payments and to manage their cash flows, he said, and of course, sidebar, making a lot from the high interest rates outstanding on credit card balances. The cards and payments sector is rapidly evolving, and access to a greater share of payments and transaction data will help drive product and service innovation across our personal banking business and deliver market-leading customer experiences. Citigroup management's team has also built strong white label partnerships with household names in the airline, retail and financial services sectors over many years. This expertise, together with our commitment to deliver market-leading products and services, provides an opportunity to grow with existing partners and add new partners. When NAB sold its MLC business recently to IOOF, it retained private wealth division to focus on servicing high net worth and self-directed clients, and the bank said it would review opportunities to extend its private wealth offer to Citigroup's clients and potentially utilise relevant services offered by Citigroup to enhance its current products and service offering. A transitional services agreement to assist with the integration of the Citigroup business into NAB is expected to be in place for approximately 30 months, of which NAB said it would invest in a new technology platform to support the combined unsecured lending business. Citigroup will continue to operate its consumer banking business until the proposed acquisition is finalised, with no immediate changes in the way it services its customers. According to Citi, NAB was selected following an auction process to acquire Citi's consumer business. Commenting on the deal, Citi CEO Jane Fraser said, "This is a positive outcome for our clients, our colleagues, and for Citi. As this transaction shows, we are moving forward with urgency as we refresh our strategy and execute the decisions we've already made as part of that effort. We are focusing our resources on businesses where we have scale and competitive advantages in order to deliver growth and improve returns over time. In addition to servicing our wealth clients through 4 global hubs, we will continue to serve our institutional clients in Australia as we have for nearly a century and across the greater Asia-Pacific region. We are very pleased with the economics of the transaction, and we will use the capital generated to invest in our strategic priorities as well as to continue to return capital to our shareholders." Now, 2 points here. First, of course, NAB wants that mortgage book because mortgage lending is the only game in town. Secondly, absolutely, the credit card business is valuable, and the white label strategies that Citi has developed over many years is something that NAB can leverage off. But the bottom line is this: we are taking a very able competitor out of the market once again, reducing competition, and we're also looking for savings predominantly from job savings and from rationalisation. In other words, less branches and less people. And I have to say that all the waffle about strategic positioning and alignment is really not very appropriate. This is fundamentally about shaking the costs out of the system and trying to drive cost savings. NAB has a track record of that. It'll be interesting to see whether it has any alternative to that ahead. Now, the ACCC says that the majority of money remitters reviewed by the ACCC are now giving consumers the tools they need to easily compare the total price of international money transfers. The ACCC recently reviewed the take-up of its best practice guidance for money remitters contained in its September 2019 Foreign Currency Conversion Services Inquiry Report. The best practice guidance recommends money remitters make reliable online price calculators available to consumers and that they clearly disclose their pricing, including all relevant fees. The recent review follows an earlier assessment finalised in June 2020, which found numerous remitters lagging best practice. 12 out of the 15 prominent remitters reviewed were either adhering to best practice price disclosure or needed to make only minor improvements to achieve best practice. We were pleased to see the improvement in price transparency across the money remittance sector that has occurred following the release of our 2019 report, ACCC Chair Rod Sims said. The upfront disclosure of relevant fees and wider availability of customisable online price calculators were among the major improvements identified by the ACCC in its latest review. This improvement is good news for the many consumers across Australia who transfer money overseas, who are now able to seek out more easily the best deal and potentially save significant amounts of money, Mr. Sims said. The ACCC's 2019 report found that for just 2 currencies, the US dollar and the UK pound, individual consumers who used the big 4 banks to send international money transfers could have collectively saved about 150 million Aussie dollars in 2017-18 if they'd instead used a lower priced international money transfer supplier. Despite the broad improvement observed by the ACCC, 3 remitters were identified as falling short of best practice. 3 remitters continue to provide inadequate transparency to their customers by only partially disclosing their fees, having unduly complex prices, or lacking a customisable online price calculator, Mr. Sims said. The ACCC has written to all 3 of these remitters to point out where they are falling short of best practice and expects to have continued engagement on this issue with each remitter. We want to see all money remitters lift their game so that consumers can benefit from greater price transparency and ultimately competition, Mr. Sims said. If we find that money remitters backtrack or do not implement best practice, we will work with the government on further measures to ensure that there is appropriate transparency for consumers. International money transfers are regularly used by a large cross-section of consumers, including those seeking to send money to family and friends overseas to help them deal with hardship arising from COVID-19. And once again, this is another case of shop around, shop around, shop around. If you go to one of the big banks, you'll be paying a lot more to send money overseas, so it is worth comparing and making sure that you get the very best deal, because if you do shop around, there are some good deals out there. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.